Unit 5 Real Estate Market Economics. Real estate economics is the utilization of economic systems to the real estate market. Through real estate economics, the patterns of prices, supply, and demand are described, explained, and predicted. The research concerning real estate trends focuses on the business and structural changes that affect the industry. The resources that the research draws on are on partial equilibrium analysis, also known as supply and demand, spatial economics, urban economics, extensive research and surveys. The main participants in the real estate market are owner-user. These investors are both owners and tenants. They purchase houses or commercial property as an investment and also to live in or use as a business. Owner. These people are solely investors. They do not use the real estate that they purchase. User-renter. These people are solely consumers. Developers. These people prepare the land for building. Facilitators. This group includes banks, real estate brokers, lawyers, and others that facilitate the purchase and sale of real estate. The components of the real estate market regarding economic standards and procedures are unique. These include durability. Real estate is durable and long-lasting. A building can usually last for decades or even centuries, and the land underneath it is essentially indestructible. Because of this, real estate markets are modeled as a stock flow market. Heterogeneity. Every unit of real estate is individual and unique regarding its location, the building, and financing. This makes pricing difficult, increases search costs, creates information asymmetry and dramatically restricts substitutability. High transaction costs. Buying and or moving into a house often costs much more than most types of investments and transactions. The costs include real estate fees, legal fees, moving costs, land transfer taxes, and deed registration fees. Long time delays. The real estate market adjustment process is subjected to time delays due to the amount of time it takes to finance, design, and construct. Because of these delays, there is potential for disequilibrium in the short run. An investment and consumption good. Someone can purchase real estate property with the expectation of achieving a return, an investment good, with the intention to use it, a consumption good, or both. This complex nature of the good means that it is not unusual for people to overinvest in real estate. Immobility. Real estate investments are locationally immobile. This means that there can be no real physical marketplace. Real estate markets are typically considered informationally and transactionally inefficient. That is because real estate markets are subject to prolonged periods of disequilibrium, such as in market disruptions. Real estate appraisals are generally conducted under some set of assumptions about transactional markets, and those assumptions are captured in the definition of value used for the appraisal. Therefore, there are some global standards for real estate value. Market value is the most used type of value in real estate appraisal globally. However, real estate appraisers use numerous other definitions of value in different situations. Liquidation value is the probable price for real property under the following conditions. The consummation of a sale will occur within a specified limited future marketing period. The market conditions currently predominating are those which interest the investor for the appraisal of the property. The buyer is prudent and knowledgeable. The seller is very motivated to sell. Limited marketing effort and time for the conclusion of a sale. Use value takes into account a particular use of the real property and does not attempt not to determine the highest best use of the real estate. For example, the appraisal might focus on the contributory value of the real estate to a business company. As Adv mentions in the Forbes article Timely Tips for the New Real Estate Investor, 2017, there are many factors that a prospective real estate investor should take into account. 1. Treat the real estate investments like the business it is. 2. Always start with a plan and good research. 3. Know your strengths and your weaknesses.